Welcome back to the Daily Hunt for Multibaggers, your go-to for AI-generated market insights. We're here on Thursday, October 16th, 2025, diving into yesterday's social media market buzz.
And what a day it was, Ethan. Our AI analyzed a significant volume of posts, flagging a wide range of stocks. The sentiment, I'd say, was a real mixed bag. Some incredibly promising narratives, but also a lot of caution where the underlying financials raised red flags.
Absolutely, Brooke. Let's jump right into it. First up, we've got American Battery Technology Company, or ABT. Now, the community was buzzing about an overreaction to a terminated DOE grant. Many saw this as a classic buy the dip opportunity, with the company insisting the project is still full steam ahead. They've been a speculative gamble for us before, but this time the optimism felt different.
Well, Ethan, while the community might see an overreaction, the cold hard numbers still scream caution. ABT is unprofitable with negative earnings per share. Their debt-to-equity ratio is alarmingly high at over 11, and the price-to-book ratio is also significantly elevated. This, along with the grant termination, just underscores the substantial financial risk. The previous rating was speculative gamble, and honestly, the KPIs haven't improved.
Okay, so for ABT, it's a stay away for us, despite the dip buying enthusiasm. Next, Advanced Micro Devices, AMD. We've had it rated as a stay away recently, but the buzz around AMD's MI450 AI chips and that huge Oracle deal, deploying 50,000 of them, is just massive. Plus the OpenAI partnership. This is putting them right up there with NVIDIA as an AI market leader.
Ethan, the momentum is undeniable, and that 31% revenue growth is certainly strong. But let's talk about that valuation. A price-to-earnings ratio of 142 is incredibly high. Also, a debt-to-equity ratio of over 6 is something to monitor carefully, especially for new investors buying in near its 52-week high. There's a lot of future growth priced in already, so any slight misstep could lead to volatility.
Fair points, Brooke, but the growth story is compelling. So for AMD, we're calling it a buy. Moving on, Applied Digital Corporation, APLD. This one came up as a comparison, described as having pumped to the moon without the earnings to back it up.
And our KPIs confirm that, Ethan. APLD has negative net profit margins, negative earnings per share, and negative operating margins. It's simply not profitable. Add to that a price-to-book ratio close to 10 and an extremely high beta of 6.5, which suggests massive volatility. It's a high-risk gamble based on hype rather than fundamentals. We've rated it stay away before, and that stands.
Understood. APLD is a stay away. Now for Cipher Mining, CIFR. Some users are really excited about their pivot from Bitcoin mining to HPC and AI data centers, boasting a big power pipeline for future deals.
But that pivot, Ethan, is being met with a lot of skepticism in the community, and the numbers are just not there. An incredibly high debt-to-equity ratio of over 25, combined with negative net profit margins and negative EPS, indicates severe financial distress. A price-to-book ratio over 10 for an unprofitable company is highly concerning. This one remains a stay away.
So CIFR is a stay away. Let's talk about Quest Diagnostics, DGX. This one had some interesting mixed signals, with NVIDIA's DGX Spark supercomputer causing some confusion, but the actual news for Quest Diagnostics suggests analyst optimism and expected earnings growth.
Yes, the fundamental news for Quest Diagnostics is quite solid. They're showing 15% revenue growth and healthy 9% net profit margins, and analysts are optimistic about upcoming earnings. The stock is also trading near its 52-week high, which is positive. While their debt-to-equity ratio is a bit high, the overall picture suggests a robust company.
I like the sound of that. For DGX, we're giving it a buy. Next, DigitalOcean, DOCN. This one had a lot of bullish hype from a popular post, portraying it as an AI play due to data centers and GPU partnerships. The poster even had a track record, leading many to jump in.
Hold on, Ethan. While the hype was significant, a deep dive into the KPIs reveals serious concerns. DOCN has a negative price-to-book ratio, indicating liabilities exceed assets, a major red flag. They also have a large zero-interest debt expiring soon, and analysts noted high customer churn. Despite the 13.6% revenue, a PE over 33 is high given these risks. We've never rated DOCN before, but the fundamentals are just too weak.
That's a strong point on the financials. For DOCN, it's a stay away. Now, EOS Energy, EOSE. We've seen some absolutely massive gains reported by users, some talking about an 8-bagger and letting millions ride. It sounds like a moonshot.
It sounds like extreme volatility and high risk, Ethan. EOS Energy is profoundly unprofitable, with negative earnings per share and a negative net profit margin. Their price-to-book ratio is also deeply negative, signaling severe financial weakness. While the revenue growth is positive, it simply doesn't compensate for the underlying financial fragility. This one has consistently been a stay away for us, and it remains so.
So EOSE is a stay away. How about Hims and Hers Health, HIMS? Users are celebrating massive gains, with some up over 200 and even 400%, and they're excited about new market expansions like menopause care.
The historical gains are impressive, Ethan, but the current valuation for new money is quite stretched. HIMs has a very high PE of almost 80 and an exceptionally high debt-to-equity ratio of over 185. While revenue growth is strong, that kind of leverage and valuation leaves very little margin for error.
All right, HIMS is a stay away. Next up, HCM2 Acquisition Corp, HOND. This is a pre-revenue nuclear SMR company generating a lot of speculative excitement around its innovative technology and regulatory progress.
Pre-revenue is the key phrase there, Ethan. HOND has zero net profit margin and a negative price-to-book ratio, which points to financial distress for an early-stage company. While the technology is interesting, commercial deployment isn't expected until the early 2030s. The stock is also near its 52-week high, so much of that future potential is already priced in. This is a very speculative long-term play with significant risk.
Agreed on the risk. HOND, H-O-N-D, is a stay away. Moving on to Intel, INTC. We've been cautious with Intel, but they're making a renewed push into AI chips, promising annual releases. That sounds like strong potential in a booming market.
Ethan, that renewed push is commendable, but the financials are lagging significantly. Intel has deeply negative net profit margins and negative earnings per share. Their revenue growth is almost non-existent at 0.002, and they carry a high debt-to-equity ratio. Analysts have even downgraded them, citing an overdone rally. We've rated Intel stay away multiple times, and it's simply not fundamentally sound right now.
For Intel, INTC, it's a stay away. Now, JFB Construction Holdings, JFB. There was a lot of buzz about new contracts, like that $18.8 million DeSoto win and a recent capital raise. Some even claimed it's debt-free and poised for a construction boom.
Brooke, I wish that were true, but our KPIs directly contradict those bullish claims. JFB has a staggering debt-to-equity ratio of over 7. Their revenue growth is actually negative at negative 26%, and they're deeply unprofitable across the board with negative net profit margins and EPS. A price-to-book ratio of 14 for a company losing money is a huge red flag. This has been consistently a stay away in our analysis.
Okay, JFB is a stay away. Let's discuss Lincoln Educational Services, LINC. The narrative here is very bullish, focusing on their crucial role in providing skilled labor for growing industries like data centers and a belief that they're undervalued.
That market demand is valid, Ethan, but the company's financials are highly leveraged. An extremely high debt-to-equity ratio of over 104, coupled with very low net profit and operating margins, makes this a risky bet. And with a PE over 47, the market is already pricing in a lot of future success that isn't reflected in current profitability.
So Link, L-I-N-C, is a stay away. Next, Nebius Group, NBIS. This stock was mentioned as having pumped to the moon alongside other AI-related companies driven by that AI buying spree.
And it certainly has, Ethan, but a PE ratio over 163 for a company with only 7.7% revenue growth and thin net profit margins of less than 1% is a highly speculative valuation. With a high debt-to-equity ratio and the stock already near its 52-week high, new investors face significant risk if that exponential growth doesn't materialize.
Another one with high hype but high risk. NBIS is a stay away. Now for a major player, NVIDIA, NVDA. Their DGX Spark supercomputer, that Microsoft contract for 200,000 GPUs, and analyst upgrades to buy with a 320 target, they are undeniably the AI market leader. We rated it a cautious buy yesterday.
And the numbers absolutely back that market leadership, Ethan. NVIDIA boasts exceptional revenue growth of 55%, a staggering net profit margin of over 52%, and a return on equity exceeding 109%. While the PE and PB ratios are high, these are justified by their unparalleled growth and profitability in a booming sector. Yes, it's volatile, but the fundamentals are incredibly strong. This looks like an upgrade to me.
That's what I like to hear. For NVDA, we're upgrading it to a buy. All right, Oklo Inc., OKLO. The U.S. Army betting on small nuclear reactors sounds big, and some even called it an early Tesla in the making, associating it with Sam Altman. We had it as a cautious buy before.
Ethan, the community sentiment on Oklo is predominantly bearish, and for good reason. This company has no revenue, negative earnings, and yet it sports a market capitalization of over $25 billion. Its price-to-book ratio of 36 is astronomical for a pre-revenue company. And let's not forget that massive share lockup expiry in December, which could flood the market. This is pure speculation, and our previous cautious buy was too optimistic.
A strong downgrade then. For OKLO, it's a stay away. Let's talk about Rigetti Computing, RGTI. There were reports of users seeing massive gains, with some up over 7,000%, calling it a meme stock and highlighting quantum computing as the new hot word. We've rated it stay away before.
Ethan, meme stock is right. Rigetti is deeply unprofitable with zero net profit margin, negative EPS, and negative revenue growth. Its price-to-book ratio is an absurd 32, which clearly indicates a severe detachment from any fundamental value. And their CEO owns 0 shares. That's a red flag. Despite the reported gains, this is a highly speculative bet on market irrationality. The stay-away rating is absolutely maintained.
All right, RGTI is a stay away. Moving on, Sana Biotech, SANA. The community is overwhelmingly bullish on this one, calling it super undervalued with 100x potential, claiming a type 1 diabetes cure with immune evasion tech, and even having Jeff Bezos' fund backing it.
While it's an early-stage biotech, which typically means negative EPS, the community's conviction and the perceived breakthrough technology are compelling. The stock has shown strong upward momentum from its 52-week low, suggesting the market is beginning to recognize its potential, even if full profitability is some way off. This looks promising.
I agree. For Sana, SANA, it's a buy. Next up, T1 Energy, TE. There was a lot of enthusiasm, but here's where it gets complicated. The social media post was actually talking about a nuclear energy company, HOND, but the KPIs we have are for T1 Energy, which is in the solar sector.
And if we look at the actual KPIs for T1 Energy, it's a very clear picture, Ethan. They have negative profitability across the board, negative net profit margin, negative EPS. Their debt-to-equity ratio is astronomically high at over 300%. 300. The stock is near its 52-week high, but for an unprofitable company with that much debt, it's a precarious position. The thematic mismatch only adds to the confusion and risk.
So TE is a stay away, given those conflicting signals and weak fundamentals. Finally, Tesla, TSLA. We had it as a stay away yesterday. But the buzz is huge, with expectations for record Q3 deliveries, a rumored humanoid robot deal, and analysts initiating it with a buy and a 520 target.
Ethan, despite the hype and those ambitious targets, the financial reality remains challenging. Tesla's PE ratio is an astonishing 255, and the most concerning KPI is the negative revenue growth of negative 11.8% on a trailing basis. While Q3 deliveries might be strong, that negative trend needs a significant reversal to justify this valuation. Coupled with a high debt-to-equity ratio, the risk for new investors is substantial.
For TSLA, that means it's still a stay away for us, despite the community enthusiasm.
Let's take a look at what we need to investigate for deeper analysis today. Investigate as buy: DigitalOcean Holdings, Inc., DOCN, Quest Diagnostics Incorporated, DGX, NVIDIA Corporation, NVDA, and Sana Biotech, Inc., SANA. Investigate as cautious buy: Advanced Micro Devices, Inc., AMD. Investigate as speculative gamble: JFB Construction Holdings, JFB. And that wraps up another episode of The Daily Hunt for Multibaggers. Remember, this podcast is for informational and entertainment purposes.
The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us.
We'll be back tomorrow for another hunt. Stay sharp, investors.